Rivian stock has dropped to a new low. So many people are asking us if the stock is crashing or if it's a good opportunity to buy. So in this video, we will analyze data on what 3 wealthy investors are doing. Are they bullish in buying or bearish in selling? And then we will share our trade strategy based on this data. Because if we follow the trades of wealthy investors, we usually make money too. After all, that's why the rich get richer on Wall Street. They have more resources and information to make better investment decisions than we do. So why not use their $1 million trades to guide us in our trade strategy? By the way, if you're not familiar, Rivian makes electric vehicles and is well known for their vans that deliver packages for Amazon. So what does the data tell us about what these wealthy investors are doing? As you can see here, 7,500 unusual options being traded by the first wealthy investor here at 2:03 p.m. The second wealthy investor, 7,000 contracts being traded at 11:25 a.m. And then the third, 5,441 being traded at 10:16 in the morning. So we will go over all 3 of these. We'll start with the first one, the earlier one, even though the last one is a lot more significant and meaningful. So let's get to the earlier one at 10:16. This is, you can see here, the expiration is June 2024. This is the 10 strike puts and the 5 strike puts. You can see here they were selling the 10 strike puts and buying the 5 strike puts. And so when we look at the data for February 26, June expiration cycle, we can see the 10 strike puts over here and the 5 strike puts over here. Now notice the volume. We have 6,000 and the open interest, 9,000 at the 5 strike puts and 23,000 at the 10 strike puts. So because the open interest is greater than the volume, these could actually be closing trades. There is still a slightly higher probability these are opening trades though, but that's just a slight probability. And if we analyze this trade based on it being an opening trade, you can see what this trade looks like. Okay, so this is the 10 strike puts over here, where they were selling the 10 strike puts and buying the 5 strike puts. And when we analyze this trade, you can see here that they are selling a put spread. And you can see that this is actually a bullish trade because we have a positive delta here. So this is selling a bull put spread. And you can see that their profit potential is limited, capped, but the stock can drop down all the way to about $8.64, and this trade would still be profitable. So this is a mildly bullish trade. Okay. And the cost of this trade, because they sold the 10 strike puts and bought the 5 strike, this is a $5 wide bull put spread. That requires $500 of buying power per contract. And since we know there was about 5,441 contracts, this trade required about $2.7 million. Okay. But as we mentioned on this trade, these could be closing trades because of the open interest. And if they were closing trades, that would mean that they are no longer mildly bullish, but maybe they are neutral, or maybe they are bearish. And that's why they closed out of that trade to take profits, for example. Or maybe they wanted to reduce their risk and they were already in a losing trade. So these are things we need to consider, and why, if the open interest is greater than the number of contracts that they were trading, that it actually decreases our probability of profit by relying on just this data. So we need to look at other data to see if we can confirm this bullishness that potentially happened, because there is still a better chance that they open the trade. So all of this being said, the open interest being greater than the volume does decrease our probability of profit. So if you do want to get access to stocks with higher probability of profit, go to our website. We'll put a link at the top here where you can diversify your portfolio with better stock picks that the wealthy investors are trading. Because the data is a lot more clear, we know that they are opening trades, as well as other data to confirm that higher probability. Because by trading the same stocks as they are trading, it makes things a lot easier. They did a lot of financial research before trading the stocks that they are trading, including fundamental analysis and technical analysis. So we don't have to do all that work. We simply need to make sure that our analysis of their trades is as accurate as possible, which is what we are doing right now. So let's take a look at the second trade as well to see what is going on for these 7,000 same strikes, 10 strike puts and the 5 strike puts as well. But this is for a different expiration cycle, January 2025. Okay, and this was 7,000 contracts. So for the January 2025s, let's take a look here. And we can see here, the data here is the same situation where the open interest is greater than the volume, 24,000, and the 5 strike puts, 8,700. That's also greater than the 7,000 that this investor was trading. So again, this could also be a closing trade, but this is slightly greater in contracts. So we already know that each of these bull put spreads costs 500 buying power, and since this one was 7,000 contracts, this one required $3.5 million. Okay, so again, this was another one of these bull put spreads where they were selling the premium, so selling the 10 strike and buying the 5 strike, right? So what this trade also tells us, because they were selling the 10 strike, is that they believe that the $10 a share for Rivian is a good price that at its intrinsic value. So they are willing to sell the 10 strike puts, okay? Essentially saying they're willing to own Rivian at $10 a share because perhaps they have done the fundamental analysis and found that the intrinsic value is greater than $10 a share. So they think it's cheap to own it at $10, okay? So again, this is a bull put spread and bullish, positive delta. All right, so let's get to the third and final investor, most significant of all of them. You can see here, this was being traded very near term now, March 15. 12 strike calls, 12 strike puts, 0.5, right? 7,500 contracts. Okay, so when we take a look at this trade for the March 15th, that's just 18 days away. So you can see here that the 12.5 strike puts, we have an open interest of 35,000, which is greater than the 7,500 unusual options. However, if we look at the call side here, at the open interest here, 3,487, this is much less than the 7,500. So we now know that the calls are being opened. And so this is a lot more meaningful to us because now we know that this trade is an opening trade. Okay, and what this trade is looks like this. Right here, the 12.5, they were selling these 12.5 strike puts and buying the 12.5 strike calls. And when you analyze this trade, you can see that this is a long synthetic trade, okay, where they have a positive delta, essentially very close to mimicking the stock. Okay, you can see that as the price goes up on Rivian here on the x-axis, the profits also go up. If it goes down, it is a loss, just like if you were to have owned the stock. But they're using this option strategy because it uses leverage. It costs also less than actually buying all the stock. Okay, so you can see here that by selling the 12.5 strike puts, they're essentially saying they're willing to own 100 shares at a 12.5. So each contract requires $1,250 of buying power. We know they did 7,500 contracts. So this trade was a $9.3 million trade. So a lot more meaningful. And the fact that it was an opening trade is also more significant to us. So based on this data, we opened a bullish trade because that was a bullish trade and the previous two trades were also bullish. And the way we did this is for the same expiration cycle for the March 15th. We bought an at the money call at the 11th strike and we sold the 12.5 strike call. And that is why you see our position here, buying and selling. Okay. And so by doing this, this is a vertical call spread. And when you analyze it, you can see it only costs about $39 per trade. So we don't have to spend so much per trade. You saw how much they had to spend per trade on their contracts, about $1,250 per contract. Well, we only have to spend $39 per contract just to trade this bullish trade here. Okay, and you can see that we're going bullish by looking at the positive delta here of 26, and you can see that we have a pretty good risk to reward ratio. We're risking the $39 of debit that we paid here to potentially make, this is our max profit on the blue line. You can see it's $111 of max profit. So we have a risk to reward ratio here of 111 divided by 39 of 2.84, which essentially means we could potentially make 284% on this trade when we are only risking 100%. So we like that risk to reward ratio. And that is what we do. We also set up option strategies that are in our favor, where we don't risk as much as what we could potentially gain. And that is very important. Okay, you always want to risk less than what you could be rewarded on. All right, so that is how we trade and why we can stay consistently profitable. Go to our website to learn more about our trade strategies and how we analyze the trades of wealthy investors. We'll put a link at the top here. And let us know in the comments below. Do you think Rivian has dropped near its lows? Do you think it's a good time to buy? Or do you think it's going to crash? Let us know. As usual, please smash the like button and have a wonderful day.